Good morning, everyone. Welcome to the November MSMF Client Podcast. I'm joined today by Mr. Cody Redding and Mr. Jay Peters. Gentlemen, thank you for joining me on this fine Thanksgiving week. Thought we could talk today a little bit about some year-end planning strategies, because as you guys know, the clients typically are on the front side of the house, but in the back side of the house here, it's pretty chaotic with all the things going on year-end wise. So I thought I'd share some of that. We could all share some of that with the clients today in terms of things to keep a lookout for, things that we are actively watching for them, and just share some of that information. Sound good? Mm-hmm. All right. So specifically, really, there's three areas that you guys know. It's really open enrollment for benefit periods for folks that have benefits provided by their employer. It's tax loss harvesting conversation time, as well as potentially a lot of planning issues surrounding individual retirement accounts or IRAs. So let's start with open enrollment. Always in open enrollment, we suggest to our clients that they review their insurance coverages to make sure their health plan they've selected, their dental, disability, life insurance, any other options in there are properly selected and maximized. But there's some other things specifically to look at. Cody, talk to me a little bit about what you tell your clients about their 401k options here at the end of the year.
Yeah, it's always a good time to take a look at your 401k and, can you cash flow wise increase the percentage that you're putting in to maximize it? A lot of plans now offer some sort of automated type system where you can put in there that you want it to go 1% per year up into a certain percentage amount. So it's kind of a set it and forget it and just kind of happens, and a lot of people don't notice. So it's a good thing. Also, do you have a Roth option? What tax bracket are you in? How long do you have until retirement, or some things to consider if a Roth is viable to use for you, and your fund lineup. Have you took a recent look at what fund options do you have? Because those are usually ever changing inside of the 401k. Are you in the right allocation? It's something as we as advisors can certainly help you out with.
Absolutely. Good stuff. Jay, let's circle back. I didn't mean to brush quickly over the insurance coverages, particularly the health insurance, because there are some intricacies involved there, specifically with these things called FSA or HSAs. Maybe you could demystify that for us a little bit and talk about why we would look at that at year end.
Yeah, and it piggybacks on what Cody was talking about as their kind of cash flow decisions, and also kind of understanding what types of claims you've had during this year, what do you expect for next year, those sorts of things. Are you, do you have children? Are you wanting to have children? Those would really change your cash flow, short term and long term. In which case, there are two things to consider. A lot of plans offer an FSA. Which is a flexible spending account that pairs with your health insurance benefit. In which case, remember that there are two parts of the FSA that are often offered. One is for the medical portion of it, and then which is called the healthcare FSA, and the other part is for dependent care. In which case, the healthcare, I think that makes sense. You can put up to $2,850, it looks like, for next year towards any of your expenses that you're expecting during the year, including deductible and different things there. Remember, with an FSA, you have to use it before the end of the year, by the way. We're going to put that in there. But then for dependent care, you can put up to $5,000, in which case you can reimburse yourself during the year for any type of dependent care costs. Now, there are asterisks on what qualifies when you talk about dependent care. It has to be qualified and certain things like that. So definitely make sure you're covered. But that's a way that you can get some tax-free money to pay for your health care and pay for your dependent care.
Super. And obviously, we have our colleagues at Sonus Benefits here across the hall or across the office. Any questions on that, people can call us. We can direct them over there, but we certainly can get expert assistance from those folks. Okay, so it's been a choppy year in the market. It was really ugly at the beginning of the year. It's kind of bounced back a little bit, but it does present an opportunity for something that we call tax loss harvesting on taxable investment accounts. So Cody, could you just explain to us how you would explain tax loss harvesting to your clients?
Yeah, so with the recent run-up that we had in the previous 3 years, not including this year, obviously, there are still a lot of unrealized gains out there, meaning gains that haven't been actually sold out and realized. And with the down market that we've had, there are some funds that have losses. So, one way we look at it is that we can help offset the gain and the loss and get maybe a little to no tax consequence. It's always a good thing to do. For a lot of clients this year, they're in a position to where they're going to have some losses that exceed their gains, and we can capture those losses basically. And there's a 31-day window that you have to not go back into the same fund, but we can offset, or we could take those losses and you can offset it a little bit towards your income. I think $3,000 for a married couple. But anything in excess of that, you can carry it forward on your tax return. So when the market does recover at some point, you'll have some gains, and you can use that to help alleviate those gains. So it's a good thing to do at the end of the year, because we kind of know maybe where the market's going to be, and for a tax situation, it's always a good thing.
Cool. Jay, what process do you go through to gather that information with our clients, and then how do you loop in their tax professional or CPA?
Yeah, so the first thing is understanding which of your holdings does have a loss, right? So we can run a quick report showing the losses per position, and then kind of coordinate with an accountant or CPA to say, here's what we're thinking, and kind of make sure it makes sense for them as well, right? And then the other thing is it presents an opportunity to not only capture that loss or gain, but to also kind of rebalance. So it's another good time to check how much risk are we taking? Should we maybe switch to a different type of strategy? It's always a good time.
Super. Great stuff. All right, so let's go to door number 3, the super duper black hole of rules and regulations, that being IRAs. Okay, so individual retirement account IRAs, Cody, let's start with there's this magical age of 72. Why is it so important?
72, yeah, and this number seems to be looking to maybe change again, but who knows? Right now it used to be 70 and a half. Now it's 72, that if you have money in a traditional IRA, that the government says, hey, you have to start taking some withdrawals out of it to pay taxes, essentially. So for a lot of our clients, some of them need that excess capital, so that's a good thing. But for, there are advantages if you don't necessarily need to take the RMD. You can actually do a QCD, a qualified charitable deduction. And basically you're giving that RMD to a charity, and you do not realize any income for your taxes on that. So it's a great way, especially with the high standard deduction that we have, that you can actually make a charitable contribution and essentially not have to pay any taxes with it. But yeah, the RMDs are always an important thing. We have to get them done by the end of the year. So if you haven't taken your RMD, you're probably going to be hearing from us here in the next couple of weeks.
Super, yeah. RMD, QCD, it's acronym heaven. All right, Jay, so when we were in the throes of the pandemic in 2020, they passed this thing called the Secure Act, and it certainly secured us in business with all the changes within IRAs. Maybe share with everybody what you've been telling your clients, how they're impacted by the changes from the Secure Act.
Sure, and there are several changes in it. To Cody's point, it sounds like there could be more changes incoming, so it feels like it's always different. But right now, one of the biggest things it affects are inherited IRAs. And with them, we're talking about most recent, if someone passed away since 2020, that's really who it's affecting for these inherited. So if we already are taking RMDs and you already have one, it doesn't affect you, right? But going forward, there are new titles based on the person who is inheriting the account, and they also switched up the rules on how long you have to take the money out. Originally, you could stretch them out over that person who's inheriting over their lifetime based on their age and different rules and different factors. Now they've shortened most of them. There are a few rules that you still can do a stretch, but for most of them, they've shortened the window to either 5 or 10 years. And to your point, it just keeps changing, and so we'll stay on top of it and let you know as we learn more about how it affects individuals. Obviously, we're trying to keep track of the accounts that we're helping with, but if there are other accounts, we'd be happy to take a look at it and say, yeah, it looks like you qualify for this one. Let's make sure you take out your RMDs for it.
Right. Yeah, there's a lot of sausage making in there.
Oh my gosh.
And we even got a clarification this year. Let me ask you, on the 10-year rule, there's some confusion whether you could wait until the end of the 10th year to take it all out if you're under the 10-year requirement, or if you had to take a little bit each year. Maybe talk to us about what the IRS said this year is how we're supposed to approach it.
Yeah, midway through, because that was last year, and then this year. Oh, by the way, let's clarify. So originally we thought we could just wait to the end of the 10th year, take it all out. And some people it makes sense.
Right.
A lot of people were already kind of taking some distributions, but now the IRS came back and said no. Everyone has a required distribution, an RMD, on those inherited account. Well, not everybody. Most people do.
Right.
Again, so many
Nuances
to this. And then I believe, tell me if this is wrong, I believe you still don't have to do it this year, but that really kind of starts next year.
Next year, right.
So it's even more complicated.
Right.
Everybody has to take an RMD, but not yet. And so there's a lot going on.
Yeah, and if you have any questions on that, please reach out to us, because we're in this stuff every day, and we're constantly looking up what the latest and greatest clarification is to make sure we're advising people the proper way.
Right.
So great stuff. I appreciate it, guys. Again, the year-end planning issues are absolutely critical, particularly in the areas of open enrollment, tax loss harvesting, and IRAs. I will offer one more public service announcement for everyone out there, and really a warning, because I know we're all seeing it. The tick up in scams going on right now and people trying to separate you from your money is absolutely epic. Whether it's email, text, or phone calls, please do not respond to any emails or phone calls that are fishy. If it's a phone call, get a phone number, hang up, call them back. If they won't give you a number, you know you're getting scammed. Don't hit any buttons on your computer. We've just in the last couple of weeks had 4 clients that have fallen into this trap. So if you got a question, feel free to call us. We're happy to walk you through it. But know they're out there. There's bad actors out there trying to separate you from your money. So Cody, Jay, appreciate your time. Folks, please give us a buzz. Use the My Rep Chat line. Email, anything you need. Any of your friends or colleagues have questions, have them reach out to us. Have a super Thanksgiving and a great holidays, and let's go Blues.